Royalty is an amount that a lessee pays to a lessor for a lease. Now, what's a lease? A lease is a special right or permission that must be granted to a lessee by a lessor in order for him to engage into a particular production activity. That's what a lease is all about. So this royalty is the amount that the lessee pays the lessor for the lease that is taken, or for the rights or permission that he needs before he can go into any production activity. You also have who is a lessee. A lessee is a party to whom a lease is granted to. That is a person that seeks for permission before he goes into a particular production activity. And this production activity is something that somebody has already been doing. So he needs a right from that person so that he can be doing the same thing or be using the same property of the lessor. That is the person that owns that particular activity. So a lessor is the person that grants or that gives permission to the lessee for that production activity. So we have examples of royalty, which is extraction of mineral resources, rights to copy or produce the work of an original author, rights to use certain devices. Now these are all rights. The rights to extract natural resources, I say, is mineral rights. The right to copy or reproduce the work of an original author is a copyright, while the right to use certain device is patent right. We'll be treating an example on royalty accounts, so we get a better understanding of how royalty accounts works, what's made up of. Let's solve an example on royalty accounts. It said Beyondu leased one newly developed computer to a larger enterprise. The stipulated terms were as follows: 2 naira for each computer sold, a minimum rent payment of 20,000 naira, then the right to deduct any excess of minimum payment over the calculated royalty in any year. So what this means is that if in a particular year the quantity that was produced is not up to the minimum rent, the lessee, which is the tenant, which is a larger enterprise, has the right to remove those short workings he had from the one he's going to have in the next year. That is, if the quantity that is produced is more after you have multiplied it with the royalty that is being paid for each computer that is sold. If it's more than the minimum rent, you are qualified to remove it from there or deduct it from there. Now, the first thing to do now is to prepare our royalty schedule. Before we prepare our royalty schedule, we ask that we are required to show the ledger accounts to record the transaction in the book of the lessee and the lessor. So which means that we are going to prepare an account for two people. The first is the lessee, which is a tenant, and the second is the lessor, which is the landlord. So which means we are acting on behalf of these two persons. We are recording these transactions, these agreements between two persons. So first, we are going to act on behalf of the lessee, which is the tenant, which is Elijah Enterprise. So the first thing to do is to create our royalty schedule. This royalty schedule guides us on what to do, make sure that we are not doing the wrong thing, make sure that we are not confused while preparing our ledger accounts. So in 1997, we had a quantity of Mr. Elijah Enterprise produced 8,000 units. So in 1997, Mr. Elijah produced 8,000 units, and the rate was 2 naira per each. So which means that the rate in this rate column is going to be 2 naira all through. So our royalty payable is the multiplication of our quantity 8,000 to the rate, which is 2 naira. So when you multiply, you have 16,000. Minimum rent, they said a minimum rent of 20,000, which is a minimum rent of 20,000 naira should be paid per annum. Short workings is when the royalty payable is not up to the minimum rent. Like 16,000 naira is less than minimum rent, which is 20,000. So our short workings is going to be 4,000 naira. Why? When you subtract 20,000 naira from 16, you're going to have 4,000. So which means that the quantity that was produced in 1997 was not up to the amount, the minimum rent that Elijah Enterprise should pay. So which means that he's going to have a loss of 4,000 naira because the landlord, which is Biodun, will not be able to take 16,000 naira as the royalty payable. The agreement that they had was that the royalty payable should be 20,000 naira, which is the highlighted amount there. Recovered was if you have any excess for a particular year and you decide to recover any short workings you had in the previous year. That's a short workings recovered. Short workings written off is in a situation whereby you were not able to cover up those short workings. It's now a loss to you and you can't recover it again. That's a short workings written off. Amount paid is after you have removed any short workings recovered and added any, or if you have had any short workings or short workings recovered, the amount that you paid the landlord, that is the amount paid. So the same process I did in 1997, I advise you to pause the video and also do the same process in 1998, or let's do 1998 together. So in 1998, they produced 9,000 quantity. And when you multiply 9,000 by 2, you're going to have 18,000. There was any short workings? Yes, which is, sorry, you have a minimum rent of 20,000. There was any short workings? Yes, because royalty payable was less than minimum rent, so which is short workings of 2,000. So I advise you to, was there any short workings recovered? No. Short workings written off? No. In 1997, the amount that was paid was 20,000 because that was the agreement made by both parties that every year a minimum rent of 20,000 should be paid. So which means in 1998 it is 20,000. Even if the quantity that was produced was not up to the amount for paying, was not up to the minimum rent. So it's going to be a loss or an expense to the tenants, which is 4,000 naira expenses and 2,000 naira expenses. So which means if there is, now in our question they say the right to deduct any, that to deduct in the following 2 years any excess of minimum rent. So which means that it was an agreement that, okay, if in a particular year you were not able to meet up with the agreement, if any other years, like after these 2 years, any other years, you were able to make more than the minimum rent, you can recover the expense or the loss you made in the previous years. So you do the same thing, you add your quantity in 1998, you multiply it by the rate, when you multiply it, you have your royalty payable, if you have your minimum rent, and that's how you're going to do. So I would advise you to pause the video and try to do it yourself. Now, as you can see, in 1999, there was no short working because royalty payable was more than the minimum rent. Now, in the agreement, they said he can recover any excess amount. So there was an excess amount of 1,600. So which means that out of these short workings he had, which is the loss of 6,000, he's going to remove 1,600 from the excess he made in 1999. So if he's going to remove such amount, what he's going to have now, how much is he going to pay? He's going to pay 20,000 naira. So do the same thing for year 2000. While you pause the video, do the same thing for year 2000. I know in year 2000 you get confused because he had an excess of 6,000 naira and he was able to pay up the loss that was made, and at the same time still had a balance. So if you are able to remove the loss or the expenses you made in the previous years, that's this short workings you made in the previous years, and you still have a balance, that's the balance you pay to the landlord. So now we are done with the royalty schedule. The next thing to do now is to prepare the ledger accounts of the lessee and also for the lessor. In the book of the lessee, you are creating three accounts. We have the lessor account, royalty payable account, and short workings recoverable or recoupable account. Now, the reason why you are creating these three accounts is because there was no sub-lessee. What sub-lessee? Sub-lessee is like a subtenant. Let's say the lessee rented that particular property or right from the landlord, then still rented it to somebody else. So that person that he rented it to is a sub-lessee, subtenant. So which means that he's taking a rent from that person and also paying a rent to the landlord. So in a case like this, like in this question, there was just lessee and lessor. There was no sub-lessee, which means that in the agreement there was no right for the which means that in the agreement the lessor did not give the lessee any right to rent the same property to any other person. So the agreement here states that if the agreement was only between the lessee and the lessor. So if in that case you have to prepare just three accounts, but in a case where there is a sub-lessee, which is a subtenant, you are going to create six accounts. You are going to create the sub-lessee account, royalty receivable account, and short workings account. So don't worry. The more you practice, the more you understand how to calculate royalty accounts. We have created a royalty schedule, and the first thing they asked us to do is to create a ledger account for the lessee. So which means that we are acting on behalf of the lessee, trying to be in the position of the lessee and create this account. So the first account to create is the lessor account, which is the landlord account. In creating a landlord account, you credit short workings and royalty payable while you debit royalty recoverable. So the reason why you are crediting royalty payable is because is let's say we are the lessee. We are paying to the landlord, Biodun. That is royalty payable, which means what is the money is what is going out is on the credit side. Short workings is an expense, is a loss that we made, which means the expense is what is going out. Then the debit side is going to be who is it going out to? It's going out to it's going to the landlord. Now the landlord is receiving the money. The landlord is receiving the money into his what? Into his bank account or as cash. We start with the first year, which is 1997. So 1997, the landlord received in his bank account. How much did he receive? How will you know how much he received? For you to know how much he received, you are going to look at the amount paid. So the amount paid in 1997 was 20,000. So you write 20,000. So also in the credit side, 1997, what happened in 1997? A royalty was paid, which is royalty payable. How much royalty was paid in 1997, which is this royalty payable in 1997 was 16,000. So royalty payable in 1997 was 16,000. Credit short workings. Now the short workings for 1997 was 4,000. So when you add up 4,000 naira you're going to have 20,000 naira. So which means that the credit and the debit side in 1997 is equal. The amount with the red color signifies that that is the balance figure of our account. So we are done with 1997. Let's move ahead to 1998. In 1998, he received a sum of money in his bank account. How much did he receive? Then you go straight to your royalty schedule. A royalty schedule in 1998, he received 20,000. So you put your 20,000. So when you put your 20,000, that's on the debit side. In 1998, on the credit side, he paid. What did he pay? He paid a royalty of, you go to your royalty schedule. In 1998, he paid a royalty of 18,000. Was there short working in 1998? Yes, short working of 2,000. So royalty of 18 and a short working of 2,000. So when you sum it up, you have an equal balance of 20,000, which means debit and the credit side are equal. So move ahead to 1999. In 1999, did he receive any amount? Yes. How much did he receive in 1999? You move ahead. 1999, he received a sum of 20,000. A sum of 20,000. And I said that if you debit short workings recoverable and you credit only short workings, and our short workings recoverable was 1,600. So when you debit short workings recoverable or short workings recoverable, you have short workings recoverable in 1999 was 1,600. So if you sum it up, you're going to have 21,600. So in 1999, in the credit side, we had a royalty payable. Royalty payable of, you can go to your schedule, royalty payable of 21,600. You can pause the video and try to work out the entry for 2000. So year 2000, he received a royalty of, you go to your schedule, a royalty of 21,600. 21,600. So was there any short workings recoverable? Yes, which was 4,400. So you put your short workings recoverable. Short workings recoverable of 4,400. Then once you go to your credit side in year 2000, you had a royalty payable of, you go to your schedule, royalty payable of 26,000. Then once you sum the debit side, going to have 26,000, which is also equal to the credit side. The next thing to do now is to create your royalty payable account. A royalty payable account, you debit the landlord or the lessor, any of which you want to use, which is Biodun. You debit his account and you credit profit and loss account because it's an expense on your end. You are paying a rent, so it's an expense. So when you debit and you credit, that's what you do in royalty payable account. Since we are creating this account on behalf of Elijah Enterprise, so let's say the account is ours. So we are paying a rent, which is royalty payable. We are paying a royalty to who? To Mr. Biodun. So which means we are debiting him and crediting our profit and loss account. So royalty payable account, you debit the lessor and you credit your profit and loss. So which means in year 1997, the lessor account, which is Mr. Biodun, how much was he paid in 1997? 20,000. Then on the credit side in 1997, what did we pay him in our profit and loss? We had an expense, which is a royalty of 20,000 naira. So you do the same thing all through. As long as you look at your schedule, how much did you pay him? The amount that is paid, that is what will be in this schedule. I advise you to do the rest yourself so that you have a clear understanding of how to calculate royalty account. You now have a royalty payable account, which I know that you have gone through the process and arrived at this result. In 1997, he was paid 20,000. In our schedule, in 1997, he was paid 20,000. In 1998, the same amount. 1999, the same amount. In year 2000, it changed to 21,600. This is how your royalty payable account is. Now, the third account to create is your short workings recoverable or recoupable account. Short workings recoverable account deals with those short workings and short workings recoverable. That's the only thing it does. Those short workings recoverable. It does not deal with the royalty payable. It is concerned with, was there short workings? Were you able to recover those short workings, or were you not able to recover those short workings? But that is the main essence of short workings account. So in our short workings account, in the year 1997, did you had any short workings in year 1997? Yes, we did. In year 1997, our accounts here, we gave 4,000 naira. Who did we give 4,000 naira? The landlord. So we are going to debit short workings. So which means, who are you giving the short workings? Lessor. Which is, and the reason why you are giving it to him is because in year 1997, our schedule, we were not able to make up to 20,000 naira. So we had to borrow the money or try to get the money in order for us to add up to this payable in 1997 in order for it to be able, in order for us to meet up with the minimum rent. So which means in 1997 we had a production of 16,000 naira computer and it was not up to 20,000 naira. So we had to look for a way to get the 4,000. So which means this 4,000 naira is also going to the landlord or the lessor to make up the minimum rent. So which means that's why you are debiting the 4,000 naira. So which means we debit our lessor of 4,000, and in year 1997, the credit side, you have a balance carried down. In order for this debit side to be equal to the credit side, balance carried down of 4,000. In 1998, you bring this balance forward to the next year. So which means this balance 4,000 naira is going forward. So balance brought down of 4,000 naira. In 1998, did you have any short workings? Yes. Short workings of 2,000 naira. In 1998, in our schedule, we had a short workings of 2,000 naira. So which means that you gave the landlord 2,000 naira in order for you to meet up with the minimum rent. So the lessor 2,000 naira. So when you add up, you're going to have 6,000. So in 1998, on the credit side, you balance up, which is balance carried down of what, 6,000 naira. So So in 1999, you bring the balance forward. Balance brought down of 6,000. In 1999, we didn't have any short workings. So which means that in 1999, we had short workings recoverable. Now, short workings recoverable is the landlord that is giving out the money, which means that it's not that the landlord is handing us the money back, because in our agreement we had a right that we have a right to recover any short workings that we made in the previous year. So that was the right. So which means that instead of us to give the landlord the full excess amount, we have the right to remove the excess and give him the minimum rent. So the lessor will give out what is our short workings recoverable in 1999. Short workings recoverable in 1999 was 1,600. So 1,600. So was there any balance carried down? Yes. In order for the credit side to balance with the debit side, you have to get the balance carried down, which is subtracting the balance in the debit side from the credit side. So when you sum it up, you're going to have 6,000 naira, which will balance up with the one on the credit side. So the last thing to do is the last year, which is year 2000. Year 2000, you bring the balance forward. Balance you had in 1999, which is 4,400. Bring it forward, which is balance brought down of 4,400. Then you go to the credit side, year 2000. Year 2000, was there any recoverable? Yes, you go to your schedule. Year 2000, there was a recoverable of 4,000. So which means the landlord gave out 4,000 in order for us to cover up the short workings that we had in our previous years. So short workings of 4,400. So we are done with short workings recoupable account. Now we are done with the account of the lessee. So the next thing to do now is to prepare the account of the lessor. Now to prepare the account of the lessor, you're just going to do the opposite of what we did in the account of the lessee, which means that we have acted on behalf of Elijah Enterprise. So now the next thing to do now is to act on behalf of Biodun, who is the lessor or the landlord. So what you're going to do now is to do the opposite of everything in this place. The opposite of everything means that everything that is on the credit side will go to the debit side, and anything on the debit side will go to the credit side. And in calculating account of the lessor, you are going to create the lessee account, the royalty receivable account, and the short workings account. So now in creating this, you're just going to get the opposite. Here we had the account of the lessor. As I said earlier, you get the opposite, which means everything on the credit side will be on the debit side, while everything on the debit side will be on the credit side. And the words too. This is royalty payable. What's the opposite of royalty payable? Royalty receivable. What's the opposite of lessee? What's the opposite of lessor? Is lessee. So you are just getting the opposite of the transaction. So which means credit will go to the debit, debit will go to the credit. While in royalty payable account, the same thing, the opposite of each other, which is this is not going to be royalty payable account, it's going to be royalty receivable account. Your short workings recoupable account will no longer be short workings recoupable, it's going to be only short workings account. So which means the lessor here will change to lessee, and you just do the opposite of the transaction, which is debit to go to credit, credit to go to debit. So you can pause the video and try to work it out yourself for a clear understanding of what you're doing. So as you can see, I have done the opposite of this transaction, which means that all the items on the credit side in our when we're working with Elijah Enterprise, we just did the opposite and this is what we got. So if you were able to do it yourself, you can first check and see. You can pause the video and check if what you did is correct and try to compare it with the one we did when preparing for Elijah. That is the Lisi account. So if you are correct, you can do the same thing for royalty receivable account. Now I'm done with royalty receivable account. So if you have done yours, you can be able to get the get a clearer view on what we did. Or if you're able to do yours, you can be able to like or try to check, compare, compare the one we did in royalty payable and the one we just did royalty receivable and be able to get the difference between the two of them. So the next thing to do now is to create the last account, which is our short workings account, which I said is the opposite of this. Everything here will come here, everything here will go to the debit side, while all the items in the debit side will go to the credit side. So the short workings will no longer be short workings equipable account, it's going to be short workings account since we are working with short workings account. So and also note that the opposite of Lissaw is also Lissi. So you can pause the video and do it. So we are done with it. So you can post check, compare the short workings account and short workings equipable account. For more video on financial costs, taxation, or any courses on accounting, please do well to subscribe and don't forget to turn on your notification icon to be notified on any new